We are so pleased to have on set today Bill Moore of BlumShapiro, and he's a tax partner and an advisor really to people about taxes. And there's a big question in a lot of people's minds about the 2018 changes in the tax law. Could you, for our audience, kind of explain the top level changes and how they might affect individuals and businesses?
Sure, and thanks for having me.
Thanks for being here.
Yeah, the biggest one for individuals is the top tax bracket. We've heard about that going down from 39.6 to 37%. That's roughly 3 percentage points. Okay. Another big one on the individual side is the increase at the income levels for the child tax credit. This used to be one where you'd phase out of this at $110,000 of income if you're married filing jointly. The credit's now $2,000 per child, and if you're married filing jointly, you can take that credit for each child under age 17 up to $400,000 of income. So that's a significant change.
And what was it before? So right now you get $2,000 per child up to the age of 17. And before it was?
Prior it was $1,000.
Okay, so that's an extra $1,000 a child.
Correct, and a lot more people will qualify for this with the income levels being raised.
Okay, because now it's up to 400 versus 110.
Correct.
And if you have two people working, a lot of people make more than 110 together.
Exactly.
Okay.
So that's one that will help a vast majority of your viewers.
Okay. Now, a lot of people are confused about deductions. It's all of a sudden, there's this one big, you don't even have to itemize anymore. You can do it on an index card. What was the premise behind that?
Yes, so that was the big buzzword, was that now 90% of the country will be able to file their tax return on a postcard. And the good news for our client base is they're not our clients. So how they thought this would work is they doubled their standard deduction. When you file a tax return, you can either take your itemized deductions or the standard deduction. Okay. The standard deduction is just a number that you're going to take regardless of what those itemized deductions are. Doubling that to $24,000 for married taxpayers is going to make almost 90% of the country not take the itemized deductions. Okay. Much easier.
So you're saying it's going to be more prevalent. In most cases, taking that $24,000 is a better deal than trying to itemize all these deductions?
Yes, especially because of the deduction they limited, which you were touching upon, which is the state taxes and the property taxes. Right. For 2017, you can take as many of those as you want. If you have two rental properties, you have your main residence, your state taxes you pay with your income, and it's going to be higher than $10,000 in a lot of cases.
In a lot of cases, yep.
In 2018, they're capping it at $10,000.
Okay. Now, what about things like giving to charitable contributions, all that kind of thing? If you take the standard deduction of $24,000 for a married couple, are you not allowed to take anything else?
That's correct.
Okay.
So you would not, your charitable deductions would not fall into.
So you literally do the postcard.
Yeah.
You literally do the postcard.
And that was some of the concern, is if you don't have $14,000 of mortgage interest plus your $10,000 of real estate taxes, you're not going to itemize. So will charities see the amount of contributions they have in the past? Of course, the number one reason to give to charities is it's a good cause. However, that was some concern back and forth when they were going through the Senate bill and the House bill. Right.
Okay. So that's the big takeaway. Now the tax rates themselves, you said they changed, though. I know that the highest tax rate went down almost 3%, but didn't let's say a couple making $150,000, their top rate actually went down also, correct?
Absolutely. Okay. So each bracket now is starting at roughly $50,000 to $60,000 to $70,000 more of income. So you're going to have $50,000 to $60,000 to $70,000 taxed at 4 to 5 to 6 percentage points less.
Which is great.
It is. It's a couple $1,000 savings. Yep. But what we need to be careful of is you hear about the decrease in the tax rates, but they've also got rid of some of the deductions, like the state taxes and the exemptions. Right. So a family of 4 with 2 children, you used to get $4,000 per child in addition to the standard deduction. That's now gone. Okay. They've replaced it with the child tax credit being increased, but it's not all gravy, I guess, is what you got to just put in perspective.
Right. And you really, each individual couple or single person has to kind of weigh the differences between if I do it this way or if I do it that way.
Correct.
And which is why a lot of people will need tax advice for next year.
Yeah, I think 2018 is an exciting year for especially our profession, but we need to get out there and make sure that we're running the different situations because there are a lot of changes, and we've only touched on the individual side to this point.
Now, okay, so let's talk about businesses, and especially around in this area, we have a lot of small businesses.
Yes.
What's the changes there? I know there's a big tax rate change.
Okay, yeah, so I'm going to start with that, but that's not really for the small businesses. The big buzzword with this whole tax reform was the corporate tax rate, which is those filing as C corporations, going from 35% to 21%.
Which is huge.
That is huge.
Yeah.
And that's a very big savings. However, the second piece of that you need to be cognizant of, because a lot of our clients, we've ran the analysis, is If you take money out of that C corporation,
Yep.
you're going to be taxed again, okay? And that rate could be 20%, 23.8% on top of the 21%.
Okay.
So if you're going to make $1 million and keep that in the company, you're going to pay 21%.
Okay.
As soon as you try to put that back in your pocketbook, you're going to pay an additional tax.
Now, is that for the owners or the dividends or whatever?
That's exactly, it's dividends, the dividends.
Oh, okay.
Okay? And also a C corporation isn't the best entity to sell the business. So there's a lot of different variables on that one. But to the small businesses,
Yeah, how does
that's
that
a lot
affect
of the
them?
flow-through entities, okay? And how they benefit is the top tax rate, as we discussed, went from 39.6 down to 37%. In addition, for 2018, there's going to be a 20% deduction on the income from that small business as long as it's in a qualifying field. Okay, and most of the fields qualify. Manufacturing qualifies, construction, real estate, distribution. What doesn't is professional service corporations, us, accountants, doctors, attorneys, things of that nature.
Right.
So when you take that into account with the rate decrease, that 39.6% income is now roughly taxed at 30%.
Okay. Now, do the small businesses, and I know there's a lot of people that are S corps that are pass-through entities. Do they get to do the same deductions as they did before? Or has that all changed too?
Good question. So for the most part, yes, the deductions have stayed. One area they have limited is meals and entertainment. Okay, so entertainment, you take you take a client or a prospect to a football game. You deduct half of that. Well, they've said entertainment's now not deductible. So no sporting tickets, no golfing, no theater, and some of the 100% deductible meals they've now rolled back to 50% or potentially zero. There's a little bit of confusion still out there as to how the meal and entertainment area is going to be handled.
Work.
And that's one of the unfortunate things right now is when you pass such a massive legislation in such short time, there's a lot of gray area, and that's what we're hoping gets clarified after this filing season is the regulations come out and clarify some of these gray areas so we can help advise our clients better.
Yeah, and the other thing about the small businesses is they kind of have to sometimes decide, am I going to do it as an S corp or do they have any other options?
Sure, they absolutely do. You could be an S corp, you can be a partnership.
Which is like a sole. It's like I'm using my own name and social security number as my pass-through.
That's actually a single member LLC. That's called the sole proprietorship.
Okay.
That doesn't have any additional filing. You'll put all the activity of that entity on your personal tax return, as you mentioned. An S corporation is a flow-through entity that you pick up on your own personal return, but if you and I own it 50-50, the entity files the return and we'll get our respective K-1s that show our share of the income, and then we put that into our personal tax return. But a lot of questions were, should I switch from an S corporation to a C corporation because the rate's 21% versus 37 and then down to 30. But when you look at the analysis, it's really only going to help in certain situations because a lot of times you take the money out of the company. And so then that's the double layer of tax.
And so every scenario is really different.
It is.
So people really need to be able to educate themselves over the next 11 months to really find out what's best for them. They can go to your website, BlumShapiro.com, where and other tax professionals will have the same thing, where you're going to try to break down the major components of this for individuals and for businesses. I know IRS.gov has this information too, but sometimes it's so overwhelming and it's not broken down sometimes into the ways that you can understand it.
I would agree, and also it's so specific even by industry, so that'll help a lot as well, is just get something industry specific or call an advisor.
Okay, thank you so much. We appreciate it.
Thanks
we
for
can
having
talk
me.
for 6 hours, but unfortunately we're out of time.
Well, thanks for having me.
Thank you.